Anil, what about you? From a rating agency standpoint, would you question such investments by mutual funds? And more importantly, have you assessed how much more corporate debt paper might hit the market as a result of this?
Yeah, good morning. See, I'll agree with the other panelists that these transactions are legitimate. And see, only concern comes when you pledge a larger portion of your holding. So as a promoter, if I'm having a 50% stake and I have pledged almost 40% and there is a stock price correction and I don't have the adequate cushion to top up my margin calls, then that becomes a risky. But if you are pledging maybe say a small portion of your holding for your temporary liquidity needs, so that should not be a problem. Moreover, the other concerns which are typically there in such transactions will be one, that typically these transactions can be over a period of 2 to 3 years. So what will be the liquidity event when the maturity comes? So how these transactions will be liquidated? Will there be a stake sale by the promoters in the company? So those are the risks apart from the stock price correction which can possibly trigger the margin calls. But otherwise it's a very common phenomena to have these transactions, and you'll have many corporate groups, promoter entities which would have borrowed. Coming to your second question in terms of the incremental supply because of the SEBI regulations. See, broadly, the SEBI regulations talks about the AA rated issuers. So if you look at the trend for the last 2-3 years, where the interest rates have been into the declining scenario and they started rising up somewhere in the third quarter of financial year 18. So prior to that, in a declining rate scenario, because the rate transmission is much faster in the debt capital markets as compared to banks, so typically there is a huge incentive for the AA rated borrowers, where the market also finds the investors to go and issue the paper. So there is an adequate demand. But what happens in a rising rate scenario, where the investors typically don't want to take a MTM risk and they typically avoid taking a duration risk. So the spread between the bank benchmark lending rate and the market rate for a corporate paper, even AA rated paper, the spread widens. So if you talk about the current situation where your bank's MCLR, let's say for example for SBI will be 8.5, a AA rated corporate can borrow at 9%, 9.2%. Whereas if you have to place a bond with a 2-3 year maturity, it will go at 10%, right? So the spread between the arbitrage is much higher, and the borrower will shift to the banking channel. Okay. So this regulation will make the supply more even and across the rate cycles. Okay. But only the reason that the penalty is very minuscule. So it is only 0.2%. So as a borrower, I'll prefer to.
Anil, I'm not at the moment worried about the borrower. I'm worried about the mutual fund investor.